It's great to be here with my wonderful panel. Actually, for those of you who are here this morning, we had an excellent session on how to architect successful M&A transactions with successful leaders here in India. And so it's great to have another group of leaders in M&A to talk to you this afternoon. I think as we came into 2023, the global economy was sort of clouded with recession and increased interest rates. We've seen a slowdown in M&A in the US and in Europe. And although the outlook is actually looking positive as we go towards the end of the year, it will be interesting now to talk about what we've seen in terms of M&A here in India. I think a lot of the panelists this morning talk about how India has become such an important market. And so I think looking at M&A here is now just as important as wondering what's going on in the US and in Europe. So I'm now going to turn over. We're going to start by looking at M&A trends in India. And Rudra, perhaps I can ask you to make a start in terms of what trends you've seen over the last 12 months or so.
Good afternoon, everyone. And thank you for being here. At least making half the seats to be occupied. We are delighted. Thank you, Stephanie. As we know, the trend in M&A actually has decreased. At least I'm talking about this year. But as we go along and as we are moving to the later part of the year, things are looking brighter. In terms of the investment cycle as of now, most of the investments are being actually followed with the government policies. If I need to talk about few sectors, specifically if I look at the new policy of the government of India, which is new logistics policy, Gati Sakti. So a lot of thrust is there in the logistics sector. Companies from Japan, I can tell you I'm at least as of now working on 6 transactions, either a fresh JV or an acquisition in the logistics sector, which is from road transport to warehousing. Entire ecosystem is being considered in this sector. Moving on to the next one is renewable energy. A lot of thrust in the renewable energy, again, are keen and following the government policies because a lot of thrust is there from the government of India in the renewable space, including in the hydrogen space. As you know, the Indian government target is to produce, I think, 5 tons per year, hydrogen by 2030. So again, a lot of thrust is there in the renewable space as a whole. Then again, ports, highway, airports, manufacturing as a whole, EV sector, food processing sector. So all these sectors are being considered in the later part of the year. And I'll say that even for the domestic investor, domestic companies, they are also going deeper in the strategic transactions as of now. So I'll stop there, Stephanie, and then we can.
Yeah, no, thank you. I mean, Hina, maybe we could talk a little bit about sort of the e-commerce industry and what you're seeing there.
Thank you, Stephanie, and thank you, Rudra. I think, like you mentioned, and like Rudra also indicated, the first half of 2023 has been slow. That's also because the e-commerce sector particularly was coming off from the weaning of the COVID tailwinds, where there was a lot of exuberance, rightly so, because digitization got a thrust during COVID. There was obviously a mellowing of that exuberance coming off the COVID effect. But what we think the second half of 2023 is going to look exciting. I'd broadly say that probably the early stage startups will see increased excitement again, both from a consolidation perspective and from an investment perspective. For the more mature startups, of course, it'll take a longer runway because they still have some journey to meet the exuberant valuations that they saw during the COVID tailwinds. But overall, I think the market will see a lot of consolidation and we'll see a pickup of activity both from domestic and foreign investors going into the balance of 2023.
So, I mean, I think that then picks up on an interesting topic, sort of foreign investors. And maybe I can direct this to Rohit to start with, but maybe you can follow on. It's a sort of the trend for direct investment in India. I mean, obviously, for a long time, we've seen a lot of investment in India for foreign investors coming in through a vehicle, be it Mauritius a while back and obviously Singapore more recently. So maybe, Rohit, you could touch on why we're seeing a bit more of a trend of direct investment.
Thanks, Stephanie. So what we've generally been seeing is traditionally, any FDI was rooted either through Mauritius or Cyprus routes, depending on how you structured your investment. Whether if it was plain vanilla equity, then you would do it through Mauritius, or if you were doing a part debt and part equity, you would do it through Cyprus. But over the years, what we've seen is that. Is this better? So over the years, what we are seeing is that a lot of this was being misused from a taxation perspective, and government has also clamped down, because what government has now started doing is that they've started having requirements both in Mauritius and Cyprus to have substance requirements, which is now a bit difficult to meet than what it used to be earlier. And because of which you are also seeing newer investment routes where Singapore and UAE have become probably more preferred destinations, and more so Singapore, because they have a good business environment. Taxation rules are simpler, ease of doing business, jurisdiction, legal proceedings, etc., is much smoother. So from that perspective, and also the government in Singapore, I think, lays a lot of emphasis on having substance in their jurisdiction as compared to Mauritius and Cyprus. So these are the things which we are seeing in terms of trends, where the typical routes, either Mauritius or Cyprus, they are now changing.
And in terms of the direct investment, why do you think people are more comfortable now investing directly in India?
So I think a couple of changes. One big thing, I think there is nothing political, but it's just that there is a lot of political stability in the last couple of years. So I think that's one big factor. Second thing is there is a robust capital market. If you see our capital market, it's been doing pretty well. The market capitalization is more than $3 trillion US dollars, so which is another good indicator. Also, what is happening is that there is a lot of participation by public. So earlier you see that there were a handful of stocks where there would be a lot of public floats, but now the public base in terms of multiple companies, where you see not only promoter holding and foreign institutional holding, but even public holding. So from that perspective, the float itself is available, which is quite high. Then what you see also is that access to debt markets has also increased. Earlier, it was very difficult to raise debts, especially for someone like MSMEs and small companies. That has increased. One thing which I think the government needs to work on, the access to foreign ownership in government bonds or government debt is still very, very low. It's about 0.9%. And as you compare it globally, it's one of the lowest in the world. But there is a transition, there is a move which is happening from the government, and there is they are hoping that by 2020, that percentage will increase to up to 10%. And hopefully the debt liquidity in the market will be north of $200 billion. So that becomes another avenue where capital access, easy access to capital becomes available to a lot of industries. Plus, one more important thing, government has given an assurance that there'll be no if I may use the word, that there will not be any retrospective regulations. So that's another comforting factor for a lot of FDI which comes into India, where we've had instances of Vodafone where they were put with some retrospective regulation. So I think that's another angle why FDI has become attractive and why people are looking at direct jurisdictions.
If I can add to what they've said, is basically apart from the confidence in India itself, you have the treaty benefit available, where now the government of India is also having FTAs with few of those countries. As we know, we already signed with UAE, we already signed with Australia, we are in direct negotiation and hopefully should be closing soon with UK. With again EU, we are in discussion. We are also in discussion with US and also Israel, which is also giving, you have direct benefit under the FTA. And not only for the trade part, but the investment comfort as well. Apart from that, geopolitical situation is the biggest factor to my mind. In terms of China plus one or any expansion beyond China or a supply chain resilience, manufacturing. I mean, if you look at the whole policy of the government is also make in India, make for the world, which is again bringing all the manufacturing supply chain to India. And then the working with some of the countries, closer country collaboration to export, or work for the whole of Asia. Like if I look at Korea, they have a new Southern Asia policy, which is dedicated for Asia and India. Similarly, India, Japan, Australia, they are working for Africa. So a lot of those geopolitical situation and the initiative with a few countries also deriving direct interest in India. Plus, you have other scheme of the government like PLI scheme, other tax restructuring in terms of the new tax rates. Also, that the government itself, when they are promoting India, when they are interacting with investors, they are encouraging them come directly. Don't take any route. If you have any disadvantage coming directly, let us know. We can change the rule. They have now Gift City is one of the examples that is there. So I mean, basically this government is far more progressive to make the change. Of course, the India is a large country. The challenges are there and will be there, but so is the opportunities here. So people are more encouraged to come directly in that sense.
And just to supplement what Rudra and Rohit said, I think there's also clarity as far as foreign investors are concerned, because there's now enough jurisprudence built around it, both the FDI policy. So it's clear what the regulations apply to you. There's no new surprises, at least what we've seen. And also the tax regime has become predictable. Earlier, there was some unpredictability around tax structuring, which is why to hedge risks, people used to come indirectly. But then once there were clear rules around, indirect transfers, etc. I mean, the level of benefit from indirect versus direct sort of went away. And therefore, people sort of preferred just doing a simple direct investment as opposed to coming through layers and then upstreaming the cash. So I think a large part of it is driven by a highly predictable foreign investment regime, and in conjunction with what Rudra said, like a government push towards sort of more progressive and more liberal opportunities around the focus sectors, manufacturing, infrastructure.
And one last thing. Sorry, this is a very interesting topic. And one last thing is that the PN3, which is Place Note 3, because you have these historical legacy issues of the shareholding from China, or I mean, basically China or Hong Kong, and that is also a big bottleneck to use those vehicles and investment routes. So basically, therefore, that is one more added factor to consider to invest in India directly without these layered issues actually.
Sorry, if I can just add one more thing. I mean, in order to sustain this environment, one more thing which the government really needs to focus on is enforceability, because right now what we see is that as long as it does not touch the realm of courts, it's all fine. But the moment we get into the judiciary system, then it's a black hole. And I think that's where India really needs to focus on, where they need to make their judiciary very, very strong and give confidence to the foreign investors that something which goes into the court system is not going to take ages for them to come out.
Yeah, no, that is very interesting. And we may come back to that. But I think what is interesting is when you've seen the rise of the Indian unicorns, many of them started off as Indian companies. And then in order to get the foreign investment, they all flipped. Most of them flipped to Singapore. And then we have seen a lot of high value fundraisers. So we act for Flipkart. We've helped them raise a lot of funds as a Singapore company. But we also helped PhonePe reverse flip back into India. And that's something that we're seeing. But there are a lot of challenges with reverse flipping. And my understanding is there's a number of unicorns which are domiciled overseas, which if some of those challenges were addressed would be keen to possibly come back to India for various reasons. Rudra, could you give me a few thoughts on that sort of reverse flipping and how you think it might, that trend might continue? Because I think at the moment, to my mind, it's still very early days in terms of how we do it.
So that's absolutely correct, Stephanie, that it is being tested and tried. Few examples, of course, in your phone pay, to my understanding, though I was not a part of the transaction, but there were a lot of tax leakage. So that's the biggest challenge. Of course, regulatory framework have been advanced to allow to consider the promoters or the entrepreneurs to consider these options. But I think if you look at, I think the driving factor is the capital market. One of the main reasons. I'll give you one example. If you look at Make My Trip, they are listing at Nasdaq. They're actually, in terms of the actual, combined, what you call market cap is only 9 to 10 times of their revenue. And if you look at same example in India for Ease My Trip, they have only a 29 million of revenue, but their market cap is 45 times. So look at, there's no match. There's no match at all. In fact, and the second big problem that on the companies going offshore had a challenge in accessing the local market. Like if I give an example of US market, as per my understanding, anything below $5 billion capital market offering is a big challenge to get a market, consumer attention or a investor attention. Whereas in India, even a $3 million or a $400 million or $500 million IPO will do well. So I think is also the sentiment part. And of course, Rohit talked about how easy it is to get debt here. The lot of policies from the government is helping these startups and the unicorns to do more. And of course, the whole thrust is to, do in India for the world. So that is also a very driving factors in that sense. And of course, the market itself, the consumer market itself in India is also the biggest driver to bring any of such companies into India.
Yeah, I agree. And I think that's one of the reasons why PhonePe wanted to come back. And, Samir, the founder, actually spoke to why they did it. But he also said, in order for more to come back, the tax position in particular has to be looked at. And there are other issues too in terms of ESOPs and everything. It's just not seen as a merger, it's seen as a restructuring, which creates many of the issues. So then restructuring, that leads nicely on to a topic that actually, Pooja, hopefully we can talk about. So in terms of restructuring and distressed M&A, it's not something I often like to talk about because I like to think that, we're sort of going to do well. But in terms of distress, how much of that are you seeing and what sort of trends are there?
Thanks, Tiffany, and a very good afternoon to everyone. We had a new insolvency and bankruptcy code in 2016, and what that really did was it shifted the trigger for insolvency proceedings from a balance sheet test to a default test. And what that has done is it has pushed a lot of companies that are distressed companies into formal insolvency proceedings in India. And for various reasons, especially one particular section, very unique section that we have in the Indian Insolvency Code, a lot of promoters actually get barred from bidding for their own companies. And what that has done is that it has actually changed a classic financial restructuring that you would typically find in other jurisdictions into an M&A process, which actually sometimes becomes a hostile M&A process. So you would have cases where companies goes into insolvency, and you have multiple investors looking for opportunities to bid for these companies, often competing with each other. You will have cases where promoters are opposing that bidding and are opposing actually the takeover of the company by a third party. And that does create very interesting situations. But what I would say for Indian Insolvency and Bankruptcy Code is that the kind of things that you could do in an insolvency proceeding by doing an M&A is something very unique and very interesting as opposed to a regular M&A activity. So for instance, you could invest in a listed company without actually doing a takeover code process. You could delist the shares of a listed company, which you would not be able to do in a regular M&A process. You could even do mergers and amalgamations by way of a revival plan in the Insolvency and Bankruptcy Code. So these are some of the benefits, and of course, the most important part being that you could actually wipe off the past liabilities of the company. So these are some of the benefits that a lot of investors are seeing when they are bidding in an insolvency process. And that has given a fillip to a lot of M&A activity in the distressed asset space. Of course, the biggest challenge that you have, especially that we keep hearing from the foreign funds and the foreign investors, is the lack of certainty and the timelines. And I'll echo what Rohit was saying, that the court processes in India, especially the National Company Law Tribunal that looks after the resolution plans and is responsible for approving the revival plan, it takes a lot of time to get those plans approved. It's a very litigious process, and there is also a lack of certainty in terms of how eventually the law will play out. So I personally feel that if we are able to fix that issue, if we are able to somehow manage the timelines, we will see a much more improved M&A process for distressed companies within the insolvency proceedings.
Thank you. And actually, one of the questions I was going to ask you was, how many foreign investors do you see actually getting involved in those proceedings?
Actually, quite a lot. And you will find generally two types of investors, either, of course, strategic or the financial investors. Most of the strategic investors, at least in my experience, have been Indian companies that are investing into the space. From a foreign investor perspective, you do see a lot of foreign funds looking for investment into this space. And a recent trend, which I have noticed at least in the last couple of years, is the entire loan-to-own strategy, where a foreign fund, either through an ARC, an asset reconstruction company in India, or otherwise would actually buy the loans of the Indian companies that are in distress, and then put the company into insolvency proceedings, and thereafter buy the company in the insolvency proceedings and manage to do a wipe-off of all the past liabilities. So that is something which I have seen in last couple of years, at least 3 or 4 cases that I have handled where this loan-to-own strategy has been implemented. But otherwise, from a foreign investor's perspective, like I said earlier, the biggest issue has always been the timelines and the fact that the process itself can get very uncertain. You do have a lot of litigation. So and I always tell my clients, the foreign investors, that you need to have patience for this process. It's going to reward you quite well, but you need to be patient to actually go through the entire process.
Yeah, no, that's interesting. We had one client who had made a number of investments in India, and actually, one of the reasons I asked that question is the promoter, because I think often the interaction between a foreigner and the promoter, and if they're unhappy, can make that process harder too.
Yeah, and one other thing from a foreign investor's perspective is also, the quality of information that you would usually get in these processes. If the promoters are hostile, you would end up getting information which pretty much is garbage, and it's very difficult to process that information from a foreign investor's perspective.
So just add one more thing to what Pooja said. So what we've seen on the fund side is that there is a lot of interest in companies which have run their course, where they are the final stages in terms of a resolution from a legal perspective, where they've gone through all the courts, district courts, high court, Supreme Court, they've tried everything, and we know the game is over for them. So then there is a lot of interest from the fund side on that perspective, where they know that it's a very short period, where the longevity in terms of the cases is not going to be too long. So that's where they step in.
One of the interesting, point that if you have investors, and recently advising a US investor for such a, bid process for acquiring a company into insolvency, they had some element of interest from China. And, then the typical process of the IBC comes, in the way, because they need to make some deposit in advance before the transfer of shares can happen. And actually, the conditions are such that you need to make the payment, otherwise you can't be participating in the bid in that sense. And the problem is, on the other hand, unless you have the approval, you can't make that money. So it's a catch-22 situation. In fact, the representation have been made to the government if they can consider at least to allow such a structure to the extent, in the process they can seek the approval. So that's a very typical, in 2 instances we had this problem.
And I'll just add to one thing, one more thing to what Rudra said. And that's one of the reasons why you see a lot of foreign investors actually wanting to partner up with the Indian players, because the Indian players obviously have more experience in how to navigate just the regulatory space, the court system, and also make some of the deposits that Rudra is talking about. So you do see a lot of cases where these foreign investors are actually tying up with the Indian investors to make these investments.
Well, that's interesting, and thank you for that. And I mean, I think if we have time later, we might talk a little bit more about China and some of the issues there. But I was going to move now on to sort of strategic M&A, and I think, you know, not necessarily in a distress sense. I mean, you talk a little bit about sort of spinning assets out, but what we have seen is sort of post the pandemic, a number of companies choosing to divest more non-core businesses. I mean, would you agree with that, Rudra? Is there something that you'd add to that?
No, absolutely. In fact, you know, the companies, there are only two types of transaction. One is one structure or one side of investment is somebody is expanding into multiple sectors, like Adani Group. They are everywhere. I mean, keeping the political side aside. But at the same time, there are groups who have been across the globe, not only in India, even Japan, Korea, US, anywhere you talk about, they are hiving off their non-core assets, or at least the businesses which are not doing well, for the efficiency purposes and also for expansion purposes, because they see synergy in terms of combining the same type of business and selling of their non-core assets. In particular, if I need to talk about in India, there are a lot of cases where the companies have hived off. Like L&T sold their mutual fund business. Citibank is also sold their retail business. So they see where the opportunities are and focusing on that, and also scaling up in the same pipeline, like Tata acquired Air India. I mean, though the different purpose was there, but at the same time, Adani acquired ACC Cements. So those deals are also happening to expand the business, and also at the same time selling off the non-core assets to the either the foreign investors or to the dedicated industry players in the same space.
And if I can just add, I think there's another element here, which might be unique to India. But I think especially in sectors like fintech, financial services, where the regulator and regulations are also evolving as the business models are evolving. There's a curious impact where the regulator, RBI for instance, for financial services, is taking a position on risk and how much risk should be on balance sheet versus other creative structures that we saw. So with new regulations coming into the space, some startups don't have the capital to flip to a more regulated kind of structure, or to a structure where they can take more risk on their balance sheet. So sometimes the regulations force M&A, where the younger startups who don't have the capital to sort of reorganize the business in a way that the regulator wants them, sort of flips into larger player. And we are seeing that especially happen in the newer sectors like financial services.
I mean, that's interesting. I think we're seeing that in Singapore, not just because of the regulator, but simply because of the market and the economy, and them actually running out of cash, needing some cash, and people are not as keen at the moment to invest. I was actually just going to ask, in terms of sort of, growth deals, I mean, what are you seeing in terms of growth deals at the moment, other than what we've just mentioned? Are you seeing them coming back? Because I think we sort of saw a number of those tail off a bit at the start of the year.
I think so far there's been less exuberance. Again, I think largely driven by the fact that most of the startup ecosystem in India is in newer sectors like e-commerce, fintech, and there was this era of frothy valuations, at least during COVID, because a large mass of the population was suddenly online now, and therefore startups could show more DUA and more users with greater optimization for customer acquisition costs. But I think that is all rationalizing now. I think based on what I see this trend going, I think younger startups will find it easier to raise growth money, because the difference between the valuation that they got, let's say, 2 years ago versus now, that journey might be smaller to ramp up to. The larger, more mature startups will still probably wait this period out because there are obviously global headwinds. They'll need more mature investors. That will probably happen later. There's still some time to it. But I think the Series A, B, C should be catching on now.
Yeah, well, that's positive.
Yeah, on the growth, if you look at the trend, I mean, or the scaling up in that sense, if you look at the trend, like I'll give you one example. Again, a steel sector, which is I think, one of the most growing sector in India. So Nippon Steel, with their JV partner Arcelor, they had acquired ArcelorMittal in the IBC process, but they could not acquire their integrated ports and the power business because it was all functioning as one, and they had an arrangement to support the business in the meanwhile. Last year, they acquired the business for about $2.4 billion, and they have invested more than $2 billion to expand the business to meet the demand for India. Similarly, there are other sectors. If you try and take the examples, you have examples in all sectors. So it is actually, as I said, that the demand itself in India, the opportunities of the growth is deriving all these factors.
I mean, it's interesting coming from Southeast Asia. Indonesia, I often look at as a very similar sort of market because, again, the demand is there. You don't actually need to go outside Indonesia. And one of the struggles is actually it's a very domestic market. And what's interesting here is there is the demand here, but it's to your point, actually, made in India for the world. Actually, it's a very different view than I think Indonesia probably has. It's sort of, you could just rely on an India market because there's enough demand. But actually what's good is it's going further than just India. Pooja, we talked a minute ago about sort of companies in distress and being able to use that process for M&A. But do you see other ways in which we can do M&A transactions in a slightly different way through courts or similar?
I mean, before talking about that, I just wanted to touch upon, even in terms of distress, obviously insolvency proceedings is not the only way in which you could have M&A investments in distress. You do have the guidelines of the Reserve Bank of India, which give a framework on how a change of management can be effected for distressed companies. And just coming back to the point that we were talking about earlier, we see a lot of in those resolution plans that are under the RBI guidelines framework. You see a lot of commitment from the promoters to actually dispose of the non-core assets to make the company leaner and to get out of distress. So that's one thing which I wanted to mention about. The other mechanisms for distressed, one is, of course, through the pre-packed mechanism. We have a very rudimentary, I would say, a pre-packaged scheme, which also operates within the framework of the Insolvency and Bankruptcy Code, but that is currently only for MSMEs. And there again, the trigger is default-based triggers, but there is a lot of discussion and talk within the government of actually changing that trigger for the pre-pack to just simple distress and what the company believes, is distress. And I feel if that happens, that's going to give a good fillip to M&A activities through pre-packs for companies which may not technically be in default but are still feeling the stress. So I think that's one mechanism, but it needs to be it needs to get simplified because the current regime is extremely complicated. And like I said, it's only for MSMEs. So they need to simplify it and they need to expand it. And that, I think, will actually bring in a lot of investment activity in this sector. On the other part that you were asking about in terms of for non-stressed companies, are there any other court-related mechanisms? Yes, we do have our classic Companies Act mechanism of mergers, amalgamations, and schemes of arrangement, under which you could merge into a company, amalgamate into a company, do a demerger, hive off to another company by way of NCLT, the National Company Law Tribunal, approved court schemes. And that, again, it's a very classic form of corporate restructuring. Unfortunately, The courts in India right now are extremely burdened, so people are very, very hesitant to use those schemes right now to do that kind of restructuring. We've, in fact, in early 2014, 2015, 2016, around that time, before the insolvency exploded and the courts got very, very burdened, we were seeing a lot of hive-offs, for instance, happening through the court schemes for various regulatory reasons. So, for instance, we had a transaction where a very regulated business was being demerged into another entity, and they didn't want to go through the classic demerger. They wanted to do a slump sale, but they still chose to go under a court-approved scheme of arrangement for it because they just felt that it'll be easier to get regulatory approvals if you have a court stamp on the scheme. Or where there were issues such as subsidies were involved from the government. So where there is a lot of regulatory interface, there we see sometimes parties actually preferring to go down the route of court-approved scheme of a merger, amalgamation, demerger, or hive-off because it just gives a little bit more sanctity to the process.
Acting for sort of foreign investors coming in, I think one of the concerns that we've had in the past is particularly the tax regulator. And the uncertainty that can bring, and with that uncertainty, the timeframes for which things happen.
Yeah, because in all the court-approved schemes, the notices have to go to the tax authorities. And very, very difficult to firstly get the tax counsel to appear in court. You will have multiple adjournments. They will come unprepared. They'll always ask for more time. And sometimes it's a very difficult process. You have the time negotiating with the tax counsels to actually come and make an appearance. So that sometimes becomes a bit of an issue.
And is that the case too with the competition authorities? Because again, I think, concerns that even if it's an internal group restructuring, they can sometimes say...
Yes, they do take sometimes, I think, extreme position. But all said and done, I think the CCI generally, it is inclined to give approvals for merger control. And, with our de minimis thresholds have really increased. So because of that, you have less companies actually going through the merger process or requiring the need to get a CCI approval. So that is one positive change that has happened. But you're right that sometimes the CCI, in terms of what transactions need to be approved, can take a very strict stand even for what you may perceive as an intra-group transfer and would not necessarily need a regulator consent, but they would want to assert their jurisdiction there.
I must add, again, just give you an example of how the government is progressive. In that sense, recently MCA, Ministry of Corporate Affairs, has made an amendment to certain fast-track merger rules, which basically allows, and it's a deeming consent from the RD, because within the ministry also, Ministry of Corporate Affairs, they understand that the RD level, which is the regional director, who actually gives the approval and gives the consent in a fast-track merger case. The fast-track merger, just to let you know, is available. This scheme is available for merger of a wholly owned subsidiary with a holding company and a merger of small companies between them or a startups. So this is again a very, very important scheme that the government or the rule that they have. But actually, practical terms, it was the actual intention of the rule was not being achieved. So now the government has said that if you don't give an approval or object to it within a certain time, it's a deemed approval. So within the government also at the central ministry level, they know what are the lacuna, where the problems are, and they are trying to progressively amend the rules.
I think I'd echo what you said. But having said that, for example, the CCI has always taken the approach, come notify, we'll see. In fact, in very small transactions, we've gone in cases where there were minuscule investments, less than 1% kind of investments we've seen. Transactions have to be notified, but then usually they're approved. I think it's more of a let us see as opposed to don't come to us. And on the point that you made, I think there are strict timelines on the antitrust side, on the fast track merger side, etc. But what we see is that the regulators will keep asking you incremental questions and keep pushing the timelines out. So what is supposed to be 60 days is never 60 days, because on the 51st day you will get a 30-page questionnaire. And then the process just goes out of whack. I think that level of discipline is coming in, and it'll be some more time, I think, before we sort of operate on a very predictable timeline on deals which have to go to the regulator in India.
Yeah, no, I mean, I think that's probably, that's our experience too. And I think to Pooja's point, actually, we generally get them cleared. It's not that they don't want to clear them, it's the timeline.
Yeah. And, it's a very curious regulator. They want to know a lot. So they will ask you for a lot of information. It's not like they don't intend to clear it. They will clear it eventually, but sometimes it can get a little painful.
And also, I think what comes in the way of M&A sometimes also is not thought through regulations or implementations. For example, you have GST, where companies have been pre and post GST, and you don't know what are the liabilities that you're going to end up with. Or for example, if you're on the income tax side, where those cases are pending and companies have challenged it, and you don't know. So those are the kind of obstacles, and these are kind of cases, as the panel has been saying, that they're never ending, because there is one thing after the other which the regulators and authorities keep on asking.
Yeah. So I think we've probably got time to cover one more topic before we go to questions. So one of the things that I've noticed is sort of the rise in warranty and indemnity insurance in India. I moved to the region 15 years ago. Back then, it was very popular in Australia. It wasn't so popular in Singapore. It was popular in the UK. Every deal we do in the US uses it. And I think you've got US investors coming to India and then exiting India and wanting to use it. So, but my understanding is a lot of people are saying there's not much, but it's coming. So I don't know, Hina or Rudra, somebody...
If I could just add on a lighter note, that in India, generally what tends to happen is that Indian promoters say that I need to get the agreement done, so I'll sign anything. And then I'll just see it out as to how it pans out. So,
I think it's not very popular as a mechanism still, for multiple reasons. I think one is that it adds a timeline and a separate track in your deal, because you're sitting and negotiating with the insurer will do their due diligence, the negotiating the insurance policies like a separate track. And therefore, in time sensitive deals, I haven't seen that as a preferred sort of mechanism. I've probably seen one R&W insurance in the recent past. And again, I think insurers also are not comfortable with the risk, like especially, let's say, tax, which can be very unpredictable. So the premiums can get so high that, the deal participants wonder if it's sort of a good parking of proceeds. Similarly, the areas around which indemnities are typically most contentious, like existing liabilities, etc., the insurers don't want to take the risk, or if they want to take the risk, the premium's very high. Again, I think as deal making stabilizes and matures in India, I think we will see increasing instances of the insurance being adopted widely. But so far, I think adoption has been low.
So just to add to what Hina said, actually that's correct. I mean, if I need to respond in numbers, maybe 1 out of 10 or maybe 2 out of 10, and only big transactions. And I have actually, for the benefit of everyone, I'm not the expert in insurance policy, but just to appraise you the exclusions, and then you will also understand why these are not preferred insurance. So one is anti-bribery is out, fraud of course is out. Forward-looking statements made in the transaction documents are out. Under stamping of the documents are out. Under funding of employees' benefits are out. Pollution and contamination related issues are out. Tax liabilities always need to be out. Of course, they can't take a risk of that. Plus, exclusions are adequacy and conditions of asset. They don't cover it. Product liability, they don't cover it. Title to the property is not. In fact, title to the property is a different policy itself. And at least in the RE M&A, this is a trend. Actually, discussion has started, because one of the biggest leakage is the premium. Like even for the normal warranty insurance, it is about 1 to 3%. depending upon the transaction value. So again, I mean, the leakage is too much. Except to the promoters who are saying, go, we'll sign to anything. And then issues identified in the DD report, they're absolutely out. Specific indemnity items are out. So a lot of excuses are there. So the real question is what I am covered for, and then I'm paying a good premium. The market is getting stabilized. You have 2-3 players, like you have Marsh, you have SDFC Argo, you have also Tata, company, insurance company as well. But I'll say that we are maybe at an elementary stage, and maybe go to the middle and then to a graduation. So, but yeah, the trend is there, and hopefully the next 3 to 4 years time, the way India is growing should be there.
And that's really interesting because I think, I mean, to Hina's point on the timing, actually, we do time-sensitive deals all the time with W&I. I think maybe it's just we know how to do it. We get people lined up at the right time. So we are seeing time-sensitive deals with W&I all the time in Singapore. To the exclusions, it's interesting. So we recently did a transaction where we actually got cover for title to the shares, where we didn't actually know that there was title to the shares. There was a potential EDI issue, and we got cover for out of insurers outside of India. To your point on premiums, I mean, we do see generally the premiums about 1 to 1.5%, and we can get that again for India deals outside of India. So maybe we should work a little bit better together with clients and help that sort of process get there a little bit more quickly. Before we talk about anything else, we've got 10 minutes left, or 5 minutes. So we turn to the audience and see if the audience have any questions. Given there was no ability to do Q&A earlier.
We are happy that we are so clear.
Okay, so maybe I just go to each of you, just 1 minute each, just to say what sector or do you think we may see more M&A activity rest of this year and going into next year?
I'll go with the numbers. I've got some numbers for the benefit of everyone. So
Maybe
that
you can pass this.
I can certainly. So yeah, so I must tell you that last year renewable space was actually down, but this year that is the most trending sector as of now. Then we have banking and fintech. In 2021 we had about $11 billion transaction, but in 2022 we had $45 billion transaction. This is combining banking, fintech, and financial services. Then moving on to energy, I already talked about 8 billion to 6 billion. It reduced, but this year actually is going up with the new policies of the government. Then if I need to give you manufacturing again, as I said, the supply chain resilience and a lot of thrust for Make in India for the world from 3 billion 2021 to $12 billion last year, which is again increasing, in all across sectors. Then technology, media, TMT is marginal increase from 2.7 billion to 3.2 in 2022, but it is expected to grow further. Then transport and logistics, as I said, it is because of the new policy, and then why the government is trying to integrate the entire ecosystem of logistics sector from ports, highway to airports, entire integration. India is lacking on the cost of logistics, and this is the focus. And we are hoping that this year, this sector alone may touch upon $4 to $5 billion. Then you have healthcare, again, 3.6 billion in 2021 to $6 billion in 2022, which is expected to grow. And EV food sector, I've already talked about. Thank you.
So from my perspective, India is a risk-reward game, right? So the risk is higher, but so is the reward. And I generally don't ascribe that there are sectors, because as a fund, you're always looking out for opportunities, and each sector, there'll be some opportunity or the other which is available. And I believe typically for most funds, you have if you're doing about 10 deals, then you have 2 or 3 which are multi-baggers, 4 or 5 are average, and rest are all write-offs, right? So that's what it is, and it depends again on the private equity fund or which sector they are looking at. But I believe each sector has deals to offer if you are able to pick the right ones.
I mean, Rudra has already said it. I was going to say logistics, but yeah, I think that's one sector I think that there is going to be a lot of activity this year. And otherwise, just from a distress space perspective, energy, infrastructure, that's something that we are seeing a lot of these companies actually going into insolvency on an infrastructure sector side. So there we're likely to see a lot of movement.
I think from my perspective, we'll see some resurgence. I think the one sector that you didn't cover, Rudra, was the public markets. I think a lot of IPOs have been put on the shelf, given the market conditions overall. So there'll be a little bit of resurgence around listings in India. That's obviously not sector specific, but generally.
But that I would assume, at least the market sentiment seems to be after the elections next year.
Yes, exactly. And if the elections sort of go the way that everybody's expecting, there will be certainly a resurgence in public market investments. Other than that, I'm very bullish about the manufacturing sector in India.
Great. Well, thank you. I think our time is up. And I think we've kept exactly to time, so we should get an award for that. So thank you all. I really enjoyed getting to know you and having the conversation today. I think it's been very entertaining, and I hope people have found it very useful.